The Japanese currency is continuously losing value and is currently testing historical lows not seen in nearly 35 years. Japan is an important region in global trade, and its monetary policies directly and indirectly influence the global economy. But why does Japan's currency continue to lose value? And how might this affect the rest of the world? On May 1, the Federal Reserve decided to keep the American interest rate between 5.25% and 5.50% per year, while the Bank of Japan maintains the interest rate at just 0.10% per year. Until recently, Japan still maintained its negative interest rate policy, and after 17 years of this policy, there were finally increases. But even so, the rate remains close to zero. In addition to these factors, Japan is currently in an economic recession, where the depreciation of the currency compared to the American dollar has caused Japan to lose its position as the third largest economy in the world. On the other hand, this currency depreciation against the dollar has helped boost the stock prices of some of Japan's largest companies by making exports of goods like automobiles cheaper in foreign markets. Another important factor is the decline in demand. The Japanese population already has a less consumerist lifestyle compared to other developed countries, but this has intensified due to rising prices and the costs of living. Another cause of the Japanese recession is the aging population. Japan has one of the lowest birth rates in the world and has been trying to combat this reality, but without much success so far. This specific factor affects many countries around the world, but in Japan, it is even more intensified due to the high life expectancy of the population. The Japanese government also faces one of the highest public debt levels in the world, making it difficult to make decisions, as the consequences are all complex. At this moment, $1 American buys approximately 155 Japanese yen, a rate not seen in about 35 years. This is caused both by the current strength of the dollar in the global scenario and a series of factors that have weakened the Japanese currency. The decision of the Bank of Japan to keep the interest rate at 0.10% has brought uncertainty to the market, especially when compared to the Federal Reserve. It is clear that the situation is delicate, and any wrong move will bring significant consequences, so the Japanese bank needs to be cautious in making decisions. On the other hand, it raises doubts in the market about the extent to which the Japanese government has control of the situation, or if they are simply unable to handle the unfolding of all this. The level of inflation also remains high. Japan, a country known for its low inflation and very stable prices, not experiencing significant variations in recent years, is feeling the price increases after several decades. Current levels of inflation have not been seen in many decades, even the food index reaching 9%, a rate last seen in 1976. These values are already enough for the Japanese population to feel the weight of inflation after a long time, changing the previously stable prices. As previously mentioned, much of this is due to the high American interest rate. But some people may wonder why the Japanese government does not increase its interest rate to make its currency more attractive. The reason they do not increase their interest rate is that the government is heavily indebted, with 265% debt relative to GDP, meaning an increase in interest rates would make it very difficult to maintain healthy public spending, potentially making the debt much larger and complicating debt rollovers. Thus, it is difficult for the Japanese government to intervene sustainably. Each move brings an undesirable countermeasure for Japan, such as selling Japanese government bonds. However, this is not possible because the central bank finances the Japanese debt, and the debt would return to the market, pushing the interest rate up. If they inject liquidity into the market and create more Japanese yen, it further contributes to the currency's depreciation. One possible measure would be to sell their American treasuries, but this is a short-term measure, and Japan would still need to rely on the American interest rate not continuing to rise. The Japanese experiment has challenged logic for the past few decades. These have been years of extraordinary monetary policy, hardly replicable in any other country. We are currently witnessing a unique and very decisive moment in Japan's history. Let us observe what decisions the Japanese government will make and how they will seek to turn this situation around.